What happens in your brain when you are trying to solve a puzzle? Your attention narrows, the world outside the puzzle fades, and your cognitive resources are channeled into a single task. Now imagine that puzzle is not on a table, but is the question of how to pay for groceries for the week. Research from behavioral economist Sendil Mullainathan and cognitive scientist Eldar Shafir reveals something profound about this state, which they call the scarcity mindset. It is not a character flaw or a lack of cognitive ability. It is an involuntary hijacking of the attentional system. Scarcity captures the mind. It creates a cognitive tunnel, forcing an intense, laser-like focus on the immediate problem of resource management. This is not multitasking. It is unitasking at an extreme level, where the brain actively suppresses other concerns, thoughts, and long-term goals to deal with the urgent financial calculation at hand. This intense focus cultivates a unique cognitive skill: constant, almost unconscious optimization. When resources are severely limited, every single decision is a complex trade-off analysis. Buying one brand of canned beans over another for a 10-cent difference is not just about saving 10 cents. It's a micro-calculation that ripples through the entire weekly budget, a variable in a complex equation that must be solved correctly. The brain, under these conditions, begins to operate like a highly efficient computer processor, constantly running optimization algorithms in the background. This isn't a conscious effort in the way one might sit down to write a budget. It becomes a default mode of thinking, a heuristic honed by thousands of daily decisions. The cognitive muscles for evaluating relative value, opportunity cost, and resource allocation become incredibly strong, turning everyday financial management into a masterclass in efficiency. Contrast this with the cognitive environment of abundance. Having more money doesn't just mean you can buy more things. It means you face an exponentially larger set of choices. Which of the 50 investment funds is best? Which of the hundreds of car models? This brings us to a phenomenon known as decision fatigue. Our capacity for making rational, well-thought-out decisions is a finite resource, much like a muscle that tires with overuse. Studies on judges have shown they are more likely to grant parole in the morning than in the afternoon. Not because they become less compassionate, but because their cognitive resources for complex deliberation have been depleted. When faced with an overwhelming number of financial options, the wealthy are more susceptible to this fatigue. They may resort to shortcuts, make impulsive choices, or simply delegate the decision to someone else, not because of a lack of intelligence, but due to the sheer cognitive burden of infinite choice. The very existence of wealth creates a psychological safety net that fundamentally alters the perception of risk. Imagine walking on a tightrope. If there is a sturdy net below you, your posture, your focus, and your willingness to try a risky maneuver all change. If the tightrope is 100 feet above concrete, your every movement is precise, deliberate, and conservative. The consequence of failure defines the decision-making process. This is the core of risk compensation theory. Studies in behavioral finance observe that individuals with a large financial cushion are statistically more likely to make riskier, more speculative investments. A bad decision might result in a 5% loss of their net worth, an abstract and recoverable event. For someone with minimal savings, the same percentage loss could be catastrophic, meaning the difference between housing and homelessness. The psychological weight of the potential outcome forces a more rigorous and cautious approach to financial choices. Our brains are not wired to treat gains and losses equally. The psychological sting of losing $100 is far more powerful than the pleasure of gaining $100. This concept, known as loss aversion, is a cornerstone of behavioral economics. For an individual with vast wealth, most financial transactions, even significant losses, fall on a relatively flat portion of their subjective value curve. The loss is noted, but it doesn't trigger a powerful emotional or physiological response. However, for an individual where that same $100 represents the budget for food, the loss is felt on the steepest, most painful part of that curve. This heightened sensitivity to loss serves as a powerful, built-in financial advisor. It encourages decisions that prioritize capital preservation and risk mitigation over speculative gains, not because of a lack of ambition, but because the emotional and practical cost of being wrong is unacceptably high. This leads to a final, crucial difference: the degree to which money is an abstract concept versus a tangible reality. For many, money is embodied. It is not just a number on a screen. It is the physical weight of groceries, the warmth of a heated room, the taste of a meal. Financial decisions are directly linked to these sensory, real-world consequences. The brain processes these choices not as numerical problems, but as decisions about immediate survival and well-being. For the very wealthy, money can become disembodied, an abstraction. It becomes a game, a score, a way of measuring success against peers. The numbers on the screen become disconnected from their fundamental purpose of securing life's necessities. This abstraction allows for decisions that are mathematically interesting but practically reckless, because the link between the number and its real-world consequence has been severed. Ultimately, the psychology of abundance can create a trap. It is called the hedonic treadmill. A large financial windfall, a huge bonus, a successful investment provides a temporary jolt of happiness, but humans quickly adapt to their new circumstances. The new level of wealth becomes the baseline. To achieve the same feeling of happiness or success again, a much larger gain is required. This can fuel a cycle of ever-increasing risk-taking, a chase for a high that is always just out of reach. Financial decisions become motivated not by a need for security, but by a need to overcome psychological adaptation. In contrast, when financial decisions are rooted in achieving and maintaining stability, the goal is not a fleeting high, but a state of enduring security. The definition of a good financial decision changes entirely. It is not the one that offers the biggest possible reward, but the one that best ensures the foundation of well-being remains intact.
Monotony has grown fast. Nearly 2,700 people have watched in the last few weeks, yet less than 0.03% are subscribed. It would mean a lot if you joined by hitting subscribe. And again, thanks for watching.